Hello, this is Kanishida from Exploratory. So let's get started. So this week's data number 7. Today, I'd like to talk about leading indicators for coming recession. So people talk about recession, or maybe the economy is not doing well. So the recession is coming soon, but when is going to come, or is it really coming? So we want to know if that recession is really coming or not, and if so, when it's coming, right? So in order to forecast something like that, we need to have leading indicators, not lagging indicators. Okay, let's get started. So before getting started, I just wanted to give you guys a disclaimer first, especially these 2 points. So any information introduced in this seminar is strictly for information purpose only, and it is not intended for solicitation of investment or investment advice. All investment decisions should be made based on your own judgment. And also, by playing this video, viewers acknowledge and accept that we will not be held as responsible for any direct or indirect loss or damage incurred by using this information or content presented during this seminar. Okay, so what is a recession? I just wanted to lay the ground here. So recession is really, when the economy is going bad, right? So that includes financial market meltdown sometimes, employment goes up, and so on. So what the definition of that is? Typically, they use sort of 2 consecutive quarters of negative GDP growth. Although we had that, I think, last year or something, but somehow that was not considered as a recession. So sometimes it depends on, I think, this organization called National Bureau of Economic Research. They actually decide considering multiple conditions, I guess. Anyway, so let's take a look at the past recessions, right? So over the maybe like the last 30 years or so, 40 years or so. So last one was obviously that 2020 when we were panicked with the whole COVID thing. That was a very short-term recession, but look at this chart right here. Basically, like when the recession happens, this is a blue line is the S&P 500 index. So the financial market went nuts, right? So the stock price went down significantly. And then the one before that, it was Lehman Brothers went down, and then that whole MBS and then all that kind of stuff. So the 2008, that was a huge recession, but also the stock market went down significantly as well. And then the one before that was a dot-com bubble busted. That recession was also the significant one. And then the S&P 500 index went down as well. So even the past year as well. So like when the recession hits, obviously, people forecast that the economy is not going to do well. And therefore, stock price tend to go down, and then the companies start laying people off. So like unemployment goes up. So it's not good to have recession, obviously. So we want to be prepared if the recession is coming or when it's coming, right? So we want to focus on the leading metrics or leading indicators, not the lagging indicators or metrics, right? So for example, the GDP, like negative growth of GDP is basically the definition of the recession. But the problem is the negative growth of the GDP is lagging, right? So we already had the past months. So like, hey, what was the GDP? And compared to the period before, but that was already happened in the past. And you can't prepare the coming recession. So what could be the leading metrics? And that 2, the 1 is unemployment rate. And you might tell me like, hey, you stupid, like because the unemployment rate, that's like when recession hits, then company lay off people, and then therefore the unemployment goes up. So that is the typical lagging indicator. Yes, I understand. But actually, though, when you look at this chart, it's you can notice something kind of interesting stuff. So unemployment goes up, that's not good, right? And then once you hit that kind of ceiling, and then that start going down, meaning like the companies start hiring more and more, so therefore unemployment rate goes down. But when it goes down, typical, let's look at here, it's like 1990 recession. Before that, the unemployment rate goes down, and then hit the bottom, and it stays there for a little bit of the period until it hit the recession line. Okay, so this is great line is when the recession starts. And here too, the recession after the dot-com bubble, unemployment went down, kept going down, and then around the 2000, hit the bottom. and then stays there for a little bit, and then start picking up, and then recession hits. Okay, and then here too, like 2008 and the Lehman shock at the time, the unemployment went down all the way and it stopped there and it started picking up a little bit, and then the recession starts. Okay, and then here too, even like a COVID stuff, like unemployment rate went down all the way, going down, and then I don't know. This is like a little bit of the stableness at the bottom, but that was kind of like a tricky one. But in the past, it seems to have the same pattern. So going down and it stay there at the bottom, and sometimes picking up. And that's when the recession starts. So unemployment rate is itself that goes up when the recession hits, but it starts showing you some kind of like an early indicator. So that's why, for example, here, this is right now, okay, until 2023 September, which is not last month. And so unemployment rate went down after the COVID, right? So the COVID panic, like we got a lot of people got unemployed, but then the companies start hiring a lot of people. So start going down, and they hit the bottom and it stays there a little bit. Right now, it's not even like going down further or going up. And then recently start showing some like a sign of like a trend is changing. So does that tell you that recession is coming or not? This is a signal that we want to pay attention to. Okay, so next one is the US Treasury negative yield curve or inverted yield curve. Okay, so this one is like, if you're familiar with it, that's fine. But if you're not familiar with the Treasury or bond market and stuff, so I'm going to just give you a quick example here. Let's say you're letting your friend borrow $100 from you, right? If you're loaning $100 to your friend, and then that friend who's basically said like he's going to, give that $100 back to you within a year. Okay, so 1 year, like you don't know, maybe there's some kind of risk. So therefore, let's say like you ask him to just give you back a 5% interest rate. I mean, you don't do that with friends. So let's pretend that you're a bank or something, right? So let's say like a 5% interest rate. Maybe okay, you decided to do the 5%. Okay, and then now you loan the $100 to another friend, and then that friend is going to give you the $100 back to you in 10 years. That's a long time, right? So in 10 years, there can be a lot of things can happen, like economy situation, life situation, health situation, all that. So you're not going to give the same 5% interest rate because there will be more risk involved. So therefore, you might decide that something higher, can be 10%, can be 10%, 20%, whatever, right? So the interest rate can be different based on how long the period of like borrowing. Okay, so that says here's a yield curve. Horizontal axis is maturity. That means like 1 year or 5 years or 10 years or 30 years. And the y-axis or the vertical axis is yield, or just simply say interest rate. And then that interest rate goes up the longer the maturity would be or longer the period of borrowing. Okay, but sometimes there can be some kind of weird phenomenon. The curve, it gets inverted. This is called inverted curve or reverse curve or negative curve, meaning the longer you borrow, somehow the interest rate goes down. That's kind of weird, right? So anyways, that can happen in some period of time. So here's the one metric in the leading indicator metric. So difference of yields, meaning like 10-year treasuries yield or interest rate minus 2-year treasuries interest rate or yield. Okay, so this 2-year can be 3 months or different term. Basically, the key point here is a longer term minus shorter time. Okay, and then when you do this subtraction, and then you trend that difference of yields by the chart like this. Okay, so that the center horizontal line is a 0, meaning like 0% difference. That means 10 years and two years is exact the same. But most of the time, like I said, it's a normal time, 10 years yield or the interest rate is higher. So therefore, this line should be above the 0. But some periods, it goes down, and that's the inverted or negative yield time. Okay, and when you observe something like that, the recession will come. This is actually almost like 100%. Like when you have the negative yield, then you will have recession. That's the pattern that kept repeat it again and again. That's like a not even like a leading indicator or anything like that. If you open the newspaper, you see that kind of news, right? So here, let's take a look at here. So this again, same thing. The gray line is a recession starting date. Okay, and then and here's a negative yield. And then after that, recession comes. Negative yield, the recession comes. Negative yield, recession comes. The same pattern over and over and over. But problem is, this negative yield comes, and then that doesn't mean recession starts right away. It sometimes takes like a year or two. When the recession will come, that's really the question. So here, people start screaming at the beginning of like a reverse negative yield. And then people are like, oh my gosh, the recession is coming, the recession is coming. And after that certain point, the trend always change, meaning the negative yield is going back to the positive yield. So right now, the trend reverse. The negative yield now start going shrinking, not as big as before. And here's the thing. Okay, let's go back to the, for example, this recession right here, right? So before the yield went negative and then go back to the positive and then recession comes. So the negative is actually kind of too early for predicting that recession. It's actually for sure recession is going to come, but recession comes after the yield curve went positive. Here is a 2001 dot bubble burst as well. So the yield went negative and then started going back to the positive. And the moment it went back to the positive, and then recession hits. Here too, it went negative and then coming back to the positive, and then recession hits. This COVID recession is actually very interesting because this one is actually touched down to zero. And it actually went slightly, I think it's like a 0 point some percent, but went negative. And they immediately went back to positive. And then the recession hits. So what does that tell you? Negative itself is actually, yes, is an indicator of the recession to come, but might not be like next 12 months or even not next 3 months. But when the positive went to positive, that's when we should be paying attention. Same thing right now. Here is a negative, it's crazy negative what's going on, right? Last 1 year or so. And then, but now the trend changed. Now the trend started going back to the positive. So I'm actually paying more attention now because this one, if this one touched the zero, I think the recession might start. And like I said, like a recession hits, and then usually there's some kind of a turmoil in the market. So this is why like we should be paying attention. Okay, so from here, so like how we get this data and how we can create a chart like this, and then like maybe visualize and then like analyze and so on, right? So like I'm gonna actually use the Exploratory and bring this data in, and then draw this chart, and also draw this like this orange line is a moving average for 30 weeks. So like I'm gonna draw that. So let's take a look. Here's like I open the Exploratory. I'm gonna import that data. How can we find the data? So this is a Fred website. It's like hosted by FRB for providing the economic metrics. And in order to get this data in Exploratory, like I have done that seminar before, so please take a look at it. And I leave the URL to that particular video in the comment section. So here, like you can find all different kind of economic metrics. One of them is you can type like here is like 10-year Treasury or something, right? Sometimes I suggest this box and it says 10-year Treasury. Obviously, like a lot of people searching for this. So if I click on 10-year Treasury, and it turned out the first one, the 10-year Treasury constant maturity minus 2-year Treasury constant maturity. That's exactly what we need, is the difference between those two. And that's perfect. So if they don't have that, then we can actually find a 10-year Treasury interest rate, and then also 2-year interest rate separately, and then like join them together and do like minus calculation. So we can do that. But luckily, we don't even have to do it. Here's a minus 2-year. And if you want to do like minus 3-year, minus 3 months, it's there as well. So I'm going to just click on the first one. Okay. And then this one is showing basically the similar chart I was using. Okay. And then so what we need is this key, this code. Okay. This is like an ID. I'm going to copy and paste and then go back to Exploratory and the plus sign. And then here the cloud apps, and then click on the Fred and then type on the series ID and just paste on the series ID, click run. And then looks like the data is coming through. I didn't set a start date, end date, so it's the whole data starting from 1976. And I'm going to click on the Save button. And this one is Treasury yield difference. And then I just save that. Okay, so data is in now. So data is from starting from 1976 June to 2023 October 23rd, which is yesterday. Okay, so let's go to the chart. This time, like we don't even have to do any data wrangling, transformation, anything like that. We can just visualize. So select the line chart, x-axis date. And this data is actually the daily. So I'm going to select the date for now, and then y-axis and the value. So this is basically a difference between 10 years and 2 years. So from here, what I wanted to do is like, this is day. I'm going to change to like weekly basis. Okay. And when I do the weekly, we have to be careful because this one, y-axis is, or default is a total. So that means like, 7 days or 5 days, whatever, it adds them up. We don't want that. So we want to change to the mean or average. Okay. And then like another thing we want to do is, hey, we want to draw those like a recession time, right? So the chart we had was like this gray line. That's the recession starting date. So I want to actually draw this line. Okay. And we can use that a reference line for the x-axis, that's the vertical. If you want to do like a y-axis horizontal reference line, you can access that menu from y-axis. But this one is the x-axis. So here the reference line, and then reference line type, I'm going to select the specific value. And then you literally type the value of the date. And then I went actually to the Wikipedia, and then it says a list of recessions in the United States. And here you can see like a when the recession starts and when the recession ends type of data. Okay, so based on this, for example, like Great Recession, December 2007. So that's when the recession starts, right? So I actually created this like 1 to 6 recession starting date. Okay, so the recent one, the 2020 February 1st and so on. So I'm going to just copy this and then just at the value, the comma separated way, and then I can just paste it here. So there are 3 values or 3, there are 6 values or 6 dates. And if I click on the apply button, what is going to happen is like now you can see those like vertical lines. Those are the dates that each recession starts. Okay. And the type of the recession. And then if I move the mouse and it says recession for now here, and then I can change that, for example, line width to be maybe like a 2, just make it like a little wider, and then that's good. And the next thing I want to do is I want to show the moving average line. Okay, so how are we going to do that? So y-axis, and you select basically the same thing. Okay, at this point, this is because again, it's total, not the total. We want to change that to average. And then, hey, we have only one line. Well, that's because these two are exactly the same thing. So it's overlaid on top of each other. So now from the second one, I want to change this one to use window calculation and then use the moving average. Okay, so if I select the moving average and the default, it says 7, that means 7 is a period. What period is that? Is actually week, because now this data is week by week. So that means 7 weeks moving average. And that's actually not really helping us to see the overall trend at all, because it's almost like the same as blue line. So I'm going to change that to 30 weeks average. So this one meaning like every single point, like going back to 30 weeks before and calculate the average, and then have that as the value. And then like you connect those values, and that's the orange line. And then another thing I'd like to do, like I want to change the color, and also like I want to do something about the legend. Okay, so let's start with the color. I want to change that to, for example, the first one to be light blue, and the second one is a light orange. And the first one is not the value. This is actually difference of yield, 10 years minus 2 years. And the second one is this moving average and the 30 weeks. And how about that? And then now like we have that here. And what I want to do is like I want to bring this up. So like I go to the property, legend, change the position to top. Okay, that looks good. And one more thing, hey, what is this gray line, right? So like I want to have this gray line in the legend. In that case, go to the reference line setting. And then there's a checkbox that says show in legend. So if I check that and I click on apply, and now it says recession. It's actually, this is recession start date. I'm going to change that. Okay. And then here it is. Like we got that chart that we were looking. So again, the key thing about this difference yield, 10 years, 2 years, it's not about when it goes negative. This is actually too early to do any action at this point, right? So but we have to be careful when this one change the trend and eventually going to the positive, and that's getting very close to the recession, but we don't know. So all I can say is like, hey, maybe like we should pay close attention. That doesn't mean it's going to come. That doesn't mean like it's going to come tomorrow. But at the same time, we don't want to be stupid. Okay, that's it for today. So today we look at the leading indicators for coming recession, and then 2 indicators are telling us a similar things. I think we should pay close attention, and we'll see what's going to happen. All right, thank you for watching, and see you in the next video. Bye.